Cyril, is your turn.
Okay, so hi everyone, thank you for being here today. I'm going to present you an empirical paper which is entitled Foreign Exchange Imbalances, a Markov-Switching approach for South Africa. This is a co-written paper with Nicola Vieggi, and this paper is linked to the international context that emerged after the 2008 crisis and also during the post-COVID episodes, in the sense that both of these episodes have led to large movements in capital, which has affected emerging economies' exchange rates and the South African rand as well. Um, in this paper, we focus on the foreign exchange market and are very interested in financial intermediaries, which is linked to the previous presentation. So that's cool that you talked about it before. So to fix ideas about the foreign exchange market, I'd like to present two graphics first. And here we have the daily turnover that I took from the Bank of International Settlements. So it just represents the daily volume exchange in the foreign exchange market. And what you see here first in the first graphic worldwide is that it really increased from the 90s and reached like 6.6 billion US dollar daily exchange on this market, which is really huge and has obviously affected emerging economies' exchange rates. What is even more interesting is the second graphic, which focuses on South Africa, in which you can see the same trend, and it reached in 2019 20,000 million US dollar per day, which is huge as well, and will obviously affect the South African rand. And what is really interesting in this graphic is the fact that the foreign exchange swaps takes a relatively bigger part in South Africa than worldwide. And it's really interesting in the sense that these foreign exchange swaps can be used to hedge, but also to do speculative investments. So it first says to us that there are speculative investments in the foreign exchange market in South Africa. And even more interesting concerning our work is that foreign exchange swaps are done through financial intermediaries, which are at the source of exchange rate movements in our model. Okay, so I'd like to link it with the literature now. And the first literature which emerged in the 2000s relating foreign exchange market and exchange rate movement is the microstructure literature, which shows that short to medium run exchange rate movements are determined by in the foreign exchange market, and more precisely by order flow and the risk in this foreign exchange market. But this is really at a micro level. More recently, we also have a macro at a micro level literature which deals with imperfect financial markets and has also shown that exchange rates are determined in the foreign exchange market. And an interesting paper here is the one of Gabe and Majori that is really a good example of how to model exchange rate in a macro framework. And in their paper, they model the exchange rate through the foreign exchange market, and it's gonna depend on position and risk in the foreign exchange market, and especially on the financial intermediaries' ability to bear risk. And their paper presents a really nice way to model the exchange rate, but doesn't aim at analyzing how shocks are going to affect the economy as a whole. So what we do in our theoretical model is that we model the exchange rate similarly to what they did in a tractable macroeconomic model, which is going to allow us to analyze the channels through which exchange rate is going to affect the economy. And the aim of the paper I'm presenting today is just to estimate our theoretical model for South Africa. Okay, so concerning this paper, first, the methodology. As I told you, we are going to estimate a macroeconomic model in which the exchange rate is driven by position and risk in the foreign exchange market. And obviously, these positions and the risk in the FX market are gonna lead to nonlinearities in exchange rate movements. So due to these nonlinearities, we choose to estimate our model with Markov-Switching. And we will introduce these nonlinearities through the VIX. I mean here that we are going to move from one low risk regime to the high risk regime through the volatility in the shock of the VIX, but I will talk about it a bit more later. Why do we use the VIX? Because as Miranda, Agrippino, and Ray have shown, this is a good proxy for the global financial cycle, which is quite interesting because here we want to check whether external factors are affecting South African rand volatility. Now, concerning South Africa more precisely, we all know that the South African rand is a highly volatile currency, and our exercise, as I just said, in this exercise, we want to check whether there is a global financial cycle which can explain part of the volatility of this currency. And then we are going to simulate shock with the parameters that we estimated in order to see whether South Africa respond to shock differently according to the regime in which the economy is evolving. Concerning the contribution of this paper, first, we show that switchings do appear, and these switchings are driven by a global financial cycle. So there are external factors which are going to determine whether we are in a low risk regime or in a high risk regime. Then we show that exchange rate volatility is larger in the risky regime and that the South African Reserve Bank accounts for this risky regime in the sense that it is going to respond differently whether South Africa belongs to the low risk regime or the high risk regime. And then through our exercise of simulation, we show that everything is going to depend on households' incentive to consume domestic and foreign goods, in the sense that their choice of consumption are going to determine whether the country borrow in international financial markets, which will determine the financial positions and exchange rate movements. Then we also show that after a shock, the South Africa is going to respond differently according to the regime in which the economy is evolving. So now I'm going to talk about the model. Before going through the equation, I just want to be clear on the way the exchange rate is going to evolve in the theoretical model, because it will allow us to understand better the results that I am going to present in a bit. So first, in the model, South Africa trades with the rest of the world and have access to international financial markets. And in this model, financial institutions are going to act as intermediaries in the international financial market, and they will have a limited ability to bear the risk. So it just means that when the financial institution hold the currency, they will need to be remunerated, and even more if the risk is higher. So there is quite of a risk premium in our model. So now, through a simple example, I'm going to explain you how the exchange rate really evolves in the model. So imagine the domestic households wants to consume abroad. The country is going to borrow in international financial market. So the financier will be long in South African rand. And what is going to happen here is that the South African rand is going to depreciate today, which will allow the future appreciation. And this future appreciation is going to remunerate the financier, which is long in the currency. And the larger the risk, the larger the initial depreciation, which is going to allow a larger appreciation in the future, remunerating even more the financier. So this is how the exchange rate is going to evolve in the theoretical model. And now the model is represented by those equations. First, we have four equations: the output gap, xt, the domestic inflation, pht, the CPI, pt, and an interest rule with RT, the interest rate. I don't talk a lot about these four equations because they are quite standard and you could find it in every microfunding model a la Gallimonaccelli. The only innovation here is the presence of the exchange rate, ET. So in equation 5 and 6, I just explained the depreciation, the expected depreciation of the exchange rate. ET. So first, an increase in ET represents a depreciation. And I here consider two cases, the UIP, in which the financier is able to absorb all the risk in international financial markets, and a case with risk. So first, under UIP, what we see is that an increase in the interest rate is going to lead to a depreciation in the future, which is exactly what the UIP states, in the sense that the yield currency is going to depreciate, which will equalize return from investing in a domestic or in a foreign currency. We have another effect of MT, which represents the import values that you can consider here as capital inflows. So we see that when there's capital inflows at time t, the currency is going to appreciate in t+1, which is a destabilizing effect. But we have the same effect in t+1. So in the end, everything is stabilizing under the uncovered interest parity. Now, if you look at in the risky period with risk, we have this new parameter gamma, which represents the risk-bearing capacities that I mentioned before. And what we see here is that for every variable, this gamma is going to destabilize the UIP. So clearly, this gamma introduces a friction in international financial markets and allows to move from the UIP and destabilizes everything. So concerning this gamma in our empirical methodology, we replace it by the VIX because we don't have data for the risk-bearing capacity. And as I told you before, the VIX is going to define whether we're changing of regime. So what is important here, first, gamma represents the VIX and it follows an AR1 process. What is important in this equation 7 is the presence of sigma gamma, which is the volatility of the shock in the VIX. And the model is going to switch through this. So as long as sigma is going to reach a certain threshold, we will move from the low risk regime to the high risk regime. So everything is driven by the volatility in the VIX in our model. Then we estimate the Markov switching, which is represented in equation 8. So this equation, we have psi, which is an n times 1 vector of constant. The matrices phi, theta, psi, and eta are n times n matrices of parameters that we are going to estimate. Xt represents the n times 1 vector of endogenous variable, and omega t represents n times 1 vector of AR1 shocks. So what is important in this equation is the presence of St, which could take two values, 1 and 2, which denotes the two alternative regimes. Regime 1 is the low risk regime, and regime 2 is the high risk regime. And T is the transition probability, which just refers to the probability from switching from regime 1 to regime 2 between time t and t+1. Then, to conclude on this slide, we also allow the monetary policy parameters to take different value according to the regime. So we are going to estimate it. We don't impose anything, but the central bank could respond differently according to the regime in which the economy is evolving. Okay, concerning the data, really quickly, we use quarterly data from 1990 to 2019. Most of the data are taken from the QPM. We just took the PPI from the FRED database and the VIX on Yahoo Finance. Okay, so now let's take a look at the results. In this table, you have the estimated parameters, which are in the column posterior mode. So first, just look at the two last line, CoFTP12 and CoFTP21. It just represents the transition probability. So for 1,2, it's the probability from moving from regime 1 to regime 2. So the probability of moving from the low risk regime to the high risk regime, and we see here that it's quite small. However, the probability of going back to the non-risky regime when you are in the risky regime is quite high and equal to 85%. Now, please take a look at the parameters in colors, which are the monetary policy parameters. So the parameters in red represent the response of the central bank to inflation. So it's quite the same in both regimes. The central bank responds approximately in the same way, whether you are in the low risk regime or in a high risk regime. Then if you look at the parameters in green, which represent the response to the output gap, we see that the central bank responds strongly in the risky regime. And it's quite interesting in the sense that it means that the central bank worries more about growth when we are in the risky regime. And to end up with these parameters, the last one, rho R, represents the response to the lagged interest rate. And we see here that the central bank cares more about the present and less about the past in the risky regime, which also totally makes sense. So that's what I wanted to say about the parameters we estimated. Now let's take a look at the switchings that appear in our model. So just focus on the second graphic, it's symmetric anyway, which represents the probability of being in the high risk regime. So when it reaches 1, the probability of being in the risky regime is 100%. So we are in the risky regime. And we see that it does appear at some period. So first, in 1995, at the last quarter, it was due to the US federal government shutdown, which has led to instabilities and uncertainty in the global financial market and put South Africa in the risky regime. Then at the end of 98, it's due to the Asian crisis. In 2001, there was a global recession, which explains it. In 2003, there was the war in Iraq, which also put uncertainty on financial market. So that's why we are in the risky regime at this moment. Obviously, in 2008, it's due to the global financial crisis. And the last peak in 2011 is due to the European debt crisis. What is interesting with this peak is that it ends in the 2012 Q3, which is exactly the moment at which Draghi talked and said we do whatever we take to go out from the crisis. So it's quite interesting that our model kept exactly this date. So now I just want to confront this regime switching with the volatility in the exchange rate. So in blue, you have the volatility in the exchange rate. And first, what is interesting here is that at every time we are in the risky regime, we see that the exchange rate volatility is high, which clearly tells us that there is part of the exchange rate volatility which is explained by a global financial cycle. However, you see that at the end of our estimation, you have some peaks which are not linked to a global financial cycle in the sense that we are in the non-risky regime. And this is due to internal factors. For example, the first peak is due to the fact that the Minister of Finance has been fired at this moment in South Africa. So it's totally internal factors. Okay, so now I'm presenting you the IRF for demand shock first, and then for a supply shock. So in red, you have the low risk regime, and in blue, the high risk regime. So let's first talk about the low risk regime, so normal time. So what is happening after the demand shock? Obviously, the output gap is going to increase, which is going to increase domestic inflation and the CPI, and leading the central bank to increase the interest rate. Then what happens in international financial market? Here we have kind of a growth effect in the sense that households want to consume more, and they want to consume more abroad in the sense that domestic inflation has increased. So the country is going to borrow in international financial markets. So obviously the financier is going to be long, as I told you before, and the currency is going to depreciate to appreciate further. Here, an increase in the exchange rate represents a depreciation. And what we can say in the risk environment is that the initial depreciation is larger, which will allow a larger appreciation in the future, remunerating more the financier, which evolves now in a riskier environment. And it's really interesting in the sense that here, the presence of the international financier absorbs the effect of the demand shock. It's like the country has to pay for borrowing money, which affects the demand shock and reduces its effect on the output gap, which is quite interesting in terms of policy. Now, let me present the supply shock. So here what we have an increase in domestic inflation, which is going to increase the CPI, leading the central bank to increase the interest rate, which is going to reduce the output gap. So once again, the domestic inflation increases. So households want to consume abroad, leading the country to borrow in international financial markets. So once again, the financier is long in South African rand, which is going to depreciate today to appreciate further. Again, in the risky environment, the exchange rate volatility is larger, so the initial depreciation is larger, which will allow a larger appreciation in the future. And this, in the risky environment, what we see is that the larger depreciation increases more the CPI, leading the central bank to respond more aggressively by increasing more the interest rate, which is going to affect more growth after the shock. So here, the presence of the financier exacerbates the negative effect of the shock. So in conclusion to what I said until now, thanks to a Markov switching model driven by the VIX, so a global financial cycle, we show that external factors are going to determine whether South Africa is perceived as a risky economy or not. And we show that in a risky environment, in the risky regime, the South African rand is more volatile, and that the South African Reserve Bank accounts for it in the sense that it responds differently according to the regime in which the South Africa is evolving. Then, thanks to our simulation exercise, we show that the household's incentive to consume domestic or foreign goods is going to determine how the exchange rate will evolve, in the sense that it will determine whether the country is going to borrow or not in international financial markets, which is going to determine financial position and exchange rate movements in the end. And to finish with, we also show with our IRF that the effect of the demand shock is absorbed by the presence of the financier, while the effect of a supply shock is exacerbated by the presence of the financier. Thank you for your attention.
Perfect, Cyril. Thank you very much. There is one message that is nice in terms of this shock, this international shock that are the focus of a lot of international literature on the transmission of credit cycle. The period of high risk, of the low risk absorption capacity of the financier tend to be quite short. Therefore, that when you enter the new regime, this regime will, the probability to go back to a stable regime is quite high. That one is from a policymaker is also respond a bit at the Ray story, because in some senses the financial cycle is important, especially or mainly during period of high risk. In normal time, there is still a lot of independence of policy. The other thing is the other second message is when you have this period of risk, fiscal policy, therefore your demand management have less efficacy in the period when you have this kind of externally driven increase in risk. And therefore, the demand shock are absorbed by this financier, by having to compensate the financier. The other thing is that you can minimize this fluctuation by minimizing, if you want, the excess demand of foreign goods. Therefore, is the national savings is a way to minimize this external, the impact of external, that these things we know, but it's nice to know that this one works through in model with this imperfect financial market. That is a sort of the next generation model we are working on. Thank you very much. Thank you, Cyril.